Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. Now, the January issue of the free IBD Extra newsletter just came out this week, and in there you'll find how to do a post-analysis, how to do a profitable post-analysis.
Which is very important.
It is. And we also have a screen in there based on IBD founder Bill O'Neill's criteria for picking stocks. So you can see, even though we're in a bad market right now, you don't want to be buying stocks necessarily. This will show you some stocks that have the kind of traits we look for.
Absolutely. Now, please come and join me. I will be in Jacksonville, Florida for a Leaderboard Summit. That is January the 23rd. I'm also out several other times this year, but we'll just start off with Jacksonville.
That's right. Now, first, let's take a quick look at the market.
Well, what a week. China halted their trading twice this week, and data showed further slowing in their economy. Then we had tensions between Saudi Arabia and Iran, and oil dropped to a 7-year low. The indexes absolutely crashed. We had them lower for 7 days in a row.
Yep.
Both the NASDAQ and the S&P are below their 50 and their 200-day moving averages. And the Dow had its worst yearly opening ever. Other than that, it was a great week in the market. Our market is, the outlook has changed to market in correction.
Well, it's not hard to see why that happened as well.
But
yeah, I mean, across the board, with very few exceptions, it was a bad week for big name stocks. And if you look at the NASDAQ chart here, you can see that we spent the last part of December wondering if it would find support at the 50-day line. Well, on January 4th, the first day of trading for the year, we got that answer. It was a big no. No support at that point. It crashed below the 50 and 200-day lines, and it kept heading lower from there. And look at the volume. The big spike in trading was a clear sign that large investors had shifted into selling mode.
And former high flyers like Amazon, Facebook, Microsoft, and Google fell beneath their 50-day lines. We had Apple breaking below the $100 level on reports of slowing shipments for their 6S and their 6S Plus phones. We had weak earnings reports from American Eagle Outfitters, The Gap, and KB Homes.
And check out Netflix, because the action of that stock is really revealing. It's one of the FANG stocks along with Facebook, Amazon, and Google. And like most stocks, it rang in the new year with a nice sharp drop, and it sent it below the 50-day line. But on Wednesday, it gave it the old college try, and it really had a nice rebound. It rose over 9% on volume 113% above average, and it got back just above that 50-day line. It even tried to rally higher on Thursday, but the selling pressure was just too much, and it closed below that benchmark.
Now, CEO Reed Hastings said in a keynote address to an audience assembled at the Consumer Electronics Show in Las Vegas that Netflix had gone live in 130 additional countries, including India, Russia, Vietnam, Saudi Arabia, and Turkey, stating that this ushered in the birth of a global TV network. And this brings a network's global footprint to more than 190 countries. They are due to report earnings the 19th.
That was a really quick international rollout.
It was.
Seems very successful. So at this point, really what you want to make sure you're doing, if you haven't done already, is to protect your portfolio and keep tracking the big name stocks. Even though they're not in buy points right now or in buy areas right now, you want to keep tracking them, look at the relative strength lines, see how they're holding up, and keep an eye out for those upcoming earnings reports.
Oh, absolutely. Now, next week, for example,
yes,
we have banks on tap. We have J.P. Morgan, we have Citigroup, Wells Fargo, and BlackRock, all due to report. So let's see what the health is of those financial institutions, and that might tell us something as we go into the rest of earnings season.
Absolutely. Now, sometimes a rear view mirror is actually more useful than a crystal ball when it comes to investing in the stock market. So instead of making predictions for 2016, let's take a look at what we can learn from earlier years, 2015 through 2011.
And at the start of each year, IBD has a recap of the year, which these are news that might have affected the market in 2015. And last year, that would have included, Matt, Greece, the European Central Bank, quantitative easing, of course, the U.S. Fed, and problems out of China.
A lot of different factors at play. Now let's start with a look at the chart for last year. You can download a version of this, by the way, from our site that includes notes on all the major events that affected the market throughout the year on a month-by-month basis. And as you can see, it was not an uptrending year.
Now, it was a year of the FANG stocks, though. We had Facebook, Amazon, Netflix, and Alphabet. It was also a year of lower oil, and we had the Fed raising rates for the first time since 2006. It was also a year of a choppy market and pretty difficult to make some very large gains. Now, as we look at the chart, you can see visually just how up and down it was. A solid trend was harder to come by, and if we got them, Matt, they sure didn't last long.
It was a very frustrating year, to be sure. Now, Facebook is a good example of how tough a year it was. It made a decent gain overall, but it wasn't smooth. It started 2015 in a base, broke out, but quickly fell back into a new pattern. It broke out again in June, but went into a more wide and loose pattern after just a few weeks. Now that reflects that roller coaster action in the indexes, and it shows why it was a frustrating year.
Okay, now another big name that was in the news quite a bit was Amazon. Now this stock's personality was to report earnings, move higher, go sideways, report earnings, move higher. It just kept doing that over and over again.
Major turnaround story for the year.
It was. In between those earnings reports, Amazon held tight, but it just didn't make huge gains in between the earnings.
Now let's go back to 2011 so we can see the buildup to where we are now. In July and August of 2011, we had an intermediate correction that some people argued was technically a bear market. Now, it did decline just over 20%, but only for a moment, and you didn't see that type of rollover in the leading stocks that you typically do in a true bear.
Now, in a more traditional bear market, the leaders would have rolled over and a new crop of stocks would have shown up. We didn't get that, Matt.
We didn't.
That didn't happen. But what did occur was that a number of leaders took a breather. They formed new bases, and then they took off again because we had a follow-through day right around Christmas, right when you're not expecting it. And then on January the 2nd, we had the government, all this fiscal cliff issues. As soon as those were resolved, boom, the market zoomed higher, and boy, did it take off. Several growth names moved higher on big volume, showing a lot of conviction. We had Apple and Chipotle, and as we can see on the chart, it was a nice, healthy uptrend that lasted until March.
That's right. Now, here's what Apple looked like at that time. It had been forming a base at the end of 2011. Then it took off in January as the general market rallied. And it did have that nice run until April when it pulled back to form a new base. And guess what? The general market was pulling back at the same time. That's always a connection between the market and individual stocks.
3 out of 4 stocks follow the general trend.
That's right. So it's always important to look at your stocks in the context of what's happening with the NASDAQ and the S&P. And that's because simply stocks do not operate in a vacuum.
No,
they're part of that bigger picture.
They absolutely are. Now, after we corrected a little bit, the market made another run before pulling back again. This is very normal and healthy action. You would normally get an uptrend for a while, and then it pulls back for a while. But in 2013, again, we had some nice sweet spots during the year when the market trended nicely higher, and it was possible to make some easier gains as opposed to 2015. Now, LinkedIn was a stock that set up in 2012, and at the end of January 2013, it began to make a nice move. This was a newer IPO. It was sporting some of those hefty triple-digit gains in earnings in sales as well.
Now, consider that if you start the bull cycle from March 2009, we were 4 years in at that point and due for a deeper correction. And in 2014, we didn't get a full-on bear market, but it was a rockier ride than what we had in 2013. So that generally happens. You get more volatility and uncertainty later in a bull cycle, and that makes it harder for growth stocks to keep rising.
Now, we had 2 10% corrections during the year, but that wasn't really enough to reset the overall market. Those were intermediate in nature. Those tend to be 10 to 12% in depth. And it would have set the stage for an easier run if we had gotten a good pullback. But we had some exciting IPOs. We had GoPro and we had Mobileye. And cybersecurity stocks began to soar also. We had Palo Alto Networks. This was a newer IPO with some fabulous high double-digit earnings and sales quarter over quarter.
And then, as we saw earlier in 2015, we got a more flat, uncertain, and still volatile market. So that created a lot of hesitant action. And we had, if you remember, we had a lot of failed breakout attempts during the year. So we don't know what 2016 will bring, but we hope that this gives you some context for what got us to this point.
Yeah. Yeah, it was not an easy beginning to the year so far.
Not a pretty start.
No. We will have some PDFs of the charts we discussed covering the market from 2011 to 2015. You can find this on our site at investors.com/investing show. In the next segment, we will talk about some lessons learned from 2015 and how you might handle this year.
Like an edge that helps you pick winning stocks faster. An edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you basis, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
We've seen how the NASDAQ and the S&P did during last year. Let's take a look at some of the top performers and some of the lessons that we can learn from them, including Netflix, LGI Homes, and Valeant Pharmaceuticals.
Now, these are all stocks that made some really nice runs during the year. Now, as we look at these names, there are reasons why they made money for investors. Netflix gained more subscribers overseas than was anticipated. Valeant Pharmaceuticals was a leading pharmaceutical company, and LGI Homes was the first-time home builder. They built the early entry homes, and they were doing very, very well in Texas and in other southern states.
Now, Netflix formed this cup with handle earlier in the year, and then it bolted out of it in April after reporting earnings. That's the key here, looking for that earnings.
That's right.
Now, from there, it held those gains and showed tight, healthy trading. So even when it pulled back to the 10-week line in July, it found support, and that made it easier to hold than more volatile stocks. So at least for that period, it was clear that large investors were enthusiastic about Netflix's prospects.
Now, the RS line was spiking into new high ground, and as Netflix made its move until things got a little sloppy in August, it was looking pretty good.
Yeah.
Now, let's back up a second. Let's take a look at the volume. The week of April the 17th, 278 million shares were traded, and volume picked up 226%. This type of action shows that the pros were in there buying shares.
And that's exactly what you want to see when you're getting into a stock. But you also need to know what are the sell signals, what are the warning signs down the road. And as Amy said, things did get sloppy for Netflix in August. You went from this nice, tight trading after the breakout to wide and loose action. And a change in personality like that is a warning sign, and it's also an opportunity to at least take some of your remaining profits off the table.
Yes, but before that happened, before that change, Matt, Netflix gave you a hefty gain of 85%. That's not too shabby. Now let's take a look at LGI Homes. This stock formed a big cup with handle base followed by a nice, tighter, smaller flat base. The week of August the 7th, it roared out of that structure, and it was up 19% for the week, with volume up 162%. Now, it climbed another 13% the following week. Volume was up again 71% higher than average, above average volume, showing the professional buying. And the company was reporting strong earnings and sales.
Right, so great buy. You're all happy right now.
Very happy.
It did pull back, but again, that's normal after such a sudden advance. But note how it stayed above the 10-week line in late August and found support there in early October. When you have a strong stock like that, you can use that 10-week line to see if fund manager support is continuing or if it's time to start cashing in.
Now, December the 4th, the stock moved higher, but then reversed sharply, closing in the bottom of the range for the week and sitting right at that 10-week line. And then the following week, it broke sharply below that line. Now, look at the huge increase in selling volume. So this was your signal to move out and to take some profits.
And it's also a really good reminder of why you want to keep close tabs on your winners. And when you have a nice profit, also set some guidelines and some rules for when you're going to take some of those gains instead of watching them fade away as they did, unfortunately, for LGI.
Oh, they did indeed. Now let's take a look at Valeant Pharmaceuticals. Now, this has drugs in the area of dermatology, neurology, and eye diseases. The company acquired Bausch & Lomb. This was in 2013. The week of January the 9th, it broke out. It was a cup with handle base, and it rose 6% with volume 52% above average.
Right, so Valeant was another one that was actually pretty easy to hold as it posted several weeks of tight trading in the lead up to earnings. The nice thing about that is it gives you a profit cushion to sit through the report. And the stock gapped up after posting another strong quarter. It rose 14% for the week on volume 279% above average, much like what Netflix did.
Yeah, it did. That's
big
the
move on
same
big volume.
story. That's right. Same story. Now, as we've stated on the show many, many times, that's why it's critical to keep your watch list up to date, including stocks that are due to report earnings. Now, when a company blows its earnings numbers out of the water, professionals take note, and that's when they dive in, and that's when they buy shares, and that's what drives the price higher, and that's what makes us money as investors. So that gives us a chance to get in. So New Year's resolution number one, keep that watch list up to date.
Boy, that is so critical. Even in a down market.
It is.
Keep
You've got to
watching.
hang in there.
Absolutely important. So let's go back to the chart and see what happened next. There was a major red flag that emerged on the week of August 21st. That was the week of the flash crash. Now, Valeant fell sharply below the 10-week line, but unlike many other leading stocks, it didn't bounce back that week. It closed almost 10% lower on volume 23% above average. That's not a massive spike in trading, but note how the volume was rising. So that type of action is a signal to scale back and reduce your exposure.
And in the next couple of weeks, Valeant just kept bumping its head against that 10-week line, so it was becoming a line of resistance. And then the week of September the 25th, it cratered over 17%. Volume picked up 111%. This was definitely a signal that the party was over. And then look at the waterfall of selling that came after that. It just got very, very ugly.
It did, and that big drop, of course, in September came when Hillary Clinton sent out her tweet.
The Big Pharma tweet.
That's right, accusing Big Pharma of price gouging, and Valeant really has not recovered from that at all yet.
No, it really hasn't. So go back and review some other winners from 2015 to see how you might have handled them better if you were in them. Or if you missed them, how could you have seen them? How could you have gotten into them better? And this goes along with doing a post-analysis of your trading for the year.
Right, and by the way, in the January issue of the IBD Extra newsletter, we have a way to do that using 5 key questions, and you'll find that at investors.com/investingshow.
Now, at the end of every year, we do have a review of what happened. As we've said, we've gone over that during the show. This year we have what we call a personal financial action plan. So be sure to take a look at it. There's some very good articles in there.
There are. And also while you're there, check out the latest issue of the IBD Extra newsletter, and you'll find things about post-analysis and that screen featuring criteria from Bill O'Neill. And you'll find that at investors.com/investingshow.
Okay, see you next week, everybody.